Welcome back. I'm Jeremy Szafron. Well, the S&P 500 is trading at a new all-time high, and the catalyst is in this morning's surprising drop in producer prices, which the market is taking as a definite all-clear signal from the Federal Reserve. Now, according to the latest data from the CME FedWatch tool, traders are now pricing in a 90% probability of a rate cut next week, with the odds of a deeper 50 basis point cut rising. Now, this optimism, however, is unfolding alongside a historic rout in the bond market. The damage in what are supposed to be safe assets is so profound that even a blue chip Apple bond from 2021 now trades at just 54 cents on the dollar, according to our next guest. Now, when we last spoke to him in May, he advised viewers to raise cash and prepare for this very divergence. Today, he argues the market's consensus view is deeply flawed. Larry McDonald, of course, founder of the Bear Traps Report, a great report that I subscribe to, and a veteran of the Lehman Brothers crash, joins us now. Good to see you, Larry.
Jeremy, thanks very much. And our book, How to Listen When Markets Speak, top 10 on Amazon. Thank you.
Top 10. I like it. it. Okay. Well, this is actually a good kind of segue for us, because in that book, and I have seen it, I mean, let's talk about today. Wall Street's taking this soft PPI print as a definite sign that inflation is almost defeated here. I mean, your work argues that there is a profound misreading of the data. What specifically do you believe the consensus is missing here?
Well, if you really look inside PPI, we were really hot last month, 2 standard deviations more than normal. And, the Trump team now is running the show at the BLS, so we don't want to say anything there. But it's kind of like, okay, really, really bad month last month, much better month this month. But over the last 4 or 5 months, and especially if you look at core CPI, or you look at ISM prices paid, Philadelphia Fed prices paid, Richmond Fed prices paid. It's very clear that the trend on inflation is bouncing, and it's going to create a problem for the Fed and the White House.
Yeah, I mean, on that data too, I mean, on inflation, the report shows companies are absorbing tariff costs, not really passing them on to the public, which is surprising. I mean, they're taking a hit on their own profits instead. And I guess my question is, doesn't the lack of pricing power tell you the American consumer is simply too weak to handle higher prices, and that the story is about a slowdown, not stagflation?
Jeremy, the bottom 60% of U.S. consumers are absolutely getting hammered. I was in Washington last week. I was at Treasury. There's real concern. The bottom 60% of consumers are being hit over the head with inflation and higher rates. It's a big concern at U.S. Treasury. But now the middle class and upper middle class have a violent storm coming at them in the form of artificial intelligence. Job destruction there. So we've got the bottom 60% in a lot of pain, and there's so many companies that show this. Just look at Sallie Mae today, look at upstart subprime lenders. But the middle class really has that artificial intelligence enemy coming at them at about 150 miles an hour.
Yeah, it's an interesting one. I saw a meme over the weekend, Larry, and it was talking about how people that are applying for jobs are using AI to essentially apply for their job, but then their HR manager is just using AI to go through those. So, I mean, where is the consumer here?
Well, that's what we're seeing today. So let's break some news. So we have our 21 Lehman systemic risk indicators that we created in 2010. Remember, we wrote the New York Times bestseller about the fall of Lehman. It's a global bestseller. It's one of the top 20 books all time, according to the CFA Institute. And I'm here to tell you that our 21 Lehman systemic indicators just went from DEFCON 2 to DEFCON 3 today.
Okay, you got to go back into that. Get into this 21. Talk a little bit about the data and why you're nervous.
Well, it really comes down to, we run a Bloomberg chat with hedge funds, mutual funds, and pension funds around the world. So we're listening to that valuable buy-side conversation. And what people are talking about, people that were extremely bullish 6 months ago on the consumer, we're talking not perma bulls or perma bears, just veteran investors that were pounding the table bullish on the consumer have turned very bearish. First of all, that's the most important. But Sallie Mae and Navi, companies that face student loans, have been really massively underperforming the financials at a rate of change that's accelerating and with lower lows. If you think about it, Linda McMahon in the White House, that team, they're trying to really bring back the student loan payments, right? So we had years of forbearance. So we've gone from a very progressive administration in the Biden team, think about this, very progressive, to a more fiscally conservative/conservative team in the Trump team. And what they're doing is they're forcing a lot of people that had those student loans. Let's just say you were making that $400 a month payment and you got a 2-year reprieve. Now they're turning that back on. And that's flowing into all kinds of subprime lending, especially today in what we call buy now, pay later names, UPST, Upstart. So we're seeing a contagion across in subprime lending that's spreading.
Interesting. Okay, so would that be? I mean, you literally wrote the book, Larry, on the Lehman collapse, and you're known for your 21 symmetric risk indicators here. I mean, if those indicators are starting to flash red today, just as they did before 2008, what is the single most dangerous parallel that you see between the markets today and the eve of that great financial crisis? Is it what you just said, these student loans? Is it more?
Well,
is it the mark to myth?
Yeah. Well, that's it. Everyone knows about this, like what we call the mark to market, mark to model, mark to myth, and that's in private credit. So private credit has been kind of festering there. There are really a lot of sophisticated investors that are dumping exposure to private credit and handing that off to retail advisors. We did a private dinner a few weeks ago in San Francisco with the most, really the highest net worth clients and financial advisors and portfolio managers. And the large financial advisors are literally telling us at the table that the branch managers and management of this brokerage firms across America are kind of force feeding these guys private credit. It's a very bad sign, because whenever you see very sophisticated investors dumping exposure to retail investors, that's something that makes, kind of the hair on the back of your neck rise up quite a bit.
Yeah. I mean, back in May, we talked about this. You warned us of a credit cycle turn coming. I mean, today, auto loan delinquencies are at an all-time high. You flagged that mark-to-myth accounting in private credit, the thing that you're just talking about. I mean, has the default cycle you forecasted officially begun?
Yes, it's begun, but we went through this in 2000. Remember, New Century Financial filed bankruptcy in the spring of 2007. And it was the largest subprime lender in the United States. And the market went up, the next 6 months. So that's what we've been going through. We're going through that now. We've had subprime issues for months now, and the market's grinding up. The market doesn't pay attention to it right away. But that's why, at the end of the day, what the Fed is trying to do is they're trying to massage interest rates below the rate of inflation because of the problems they're really worried about. They want to get rates down, right? So they want to massage interest rates down as fast as they can because they're very concerned about the consumer. But the bullish thing for us, and that's why we've been long gold miners, we've been long uranium names, we've been long hard assets. It's all in our book, How to Listen to Market Speak. That hard asset portfolio construction in this kind of world of potentially stagflation, slowing growth, and sustained inflation, that's where that hard asset portfolio dramatically outperforms U.S. equities in the S&P 500.
Yeah, it's been interesting talking about it and seeing these divergences. Gold, silver prices right now, you're watching them carefully. We need to get into the miners and where you're investing in this market. All cash still? Have you just been deploying it?
Well, we put, in our trade alerts that are real time at the Bear Trap support, we did almost 20 trade alerts in April and May on the buy side. So we were buying a lot of what we love is the NUKZ names. So look at the NUKZ portfolio in its artificial intelligence infrastructure. So all the energy companies that go into artificial intelligence, those names are very high beta. So we had a lot of exposure. We had a lot of exposure to Cameco, a lot of exposure to the uranium names, a lot of exposure to Vistra, and all of those names are in the NUKZ ETF. We've taken that down dramatically because we don't want to be long high beta when we think there's something coming. Just like we saw in April, there was a violent move down in the high beta names, which move more than the market, right? All that means is high beta names move more than the market when the market goes down. We want to take those names down now, raise cash, and be there for the next puke.
Yeah, interesting. I got to ask you. I mean, I was watching that last tape too, and you called for the 10-year yield to hit the 5.25% by year end. It's now about 4. You also saw the S&P pulling back to about 4,200. It's now breaking these records. I mean, something happened over the last 4 months that dramatically kind of, changed the forecast here. How are you coming back into the market? This is the AI side?
Well, remember the global yields. So global duration, what we call
Yeah.
bond yields, have been ripping higher in the UK, France, Japan. So global yields are definitely ripping higher. And remember, if you're long duration, and all that means is longer term bonds, you're losing money since 2022. And that's a big driver into hard assets, the copper names, the uranium names, the gold, silver names. So when people are losing money in long-term bonds for longer and longer and longer periods of time, we're going on 3-4 years now, that money moves from what we call financial assets, which are bonds and growth stocks, and it moves toward hard assets. That's what's happening.
Yeah, interesting. I want to get to your most contrarian call. I mean, the potential 50% crash in Nvidia. I have to mention the news from Oracle. You and I talked about it before coming on air, which just posted an eye-popping forecast, and even analysts are surprised. I mean, its stock surged to over 40%. How does Oracle's blockbuster report factor into your thesis about the broader AI trade is a bubble?
Well, it's more about the infrastructure and energy,
Right.
and all the tentacles that are going to be required to put this together. They're just not there yet. The power grid in the United States is 50 years old, in some spots 30 years old in others. There's not enough pipelines on the natural gas space. There's not enough investment in energy infrastructure to really prevent bottlenecks. So in other words, even though if Oracle's had a great day today, it's up 30%, you can still fit 4 oracles inside Nvidia.
Yeah.
Think about that. 4 oracles. Nvidia's 4 trillion, or Oracle's a little bit less than a trillion. So the natural gas space we're most bullish on now, the FCG ETF. If you look at the FCG ETF, the top 3 companies are only worth about $250, $260 billion, right? So the only way that Nvidia reaches its growth potential is if the natural gas equities are up 500%. That's my view. In other words, you need energy infrastructure to support these data centers. And all NVIDIA's growth is based off of data center construction and implementation, right? So the moment there's any kind of energy bottlenecks, which you can clear, just look at the price of electricity. It's literally going up vertically across the United States. That's a huge, by the way, that's a big problem for politically for NVIDIA and for a lot of AI companies. So we're going to see a massive explosion in the valuations of energy infrastructure companies. We love Antero Equity, AR, and we love Range Resources, which we can get into if you'd like.
Interesting. Okay, so that's natural gas side. I mean, are you looking, is it just picks and shovel plays now? Are you still looking at the broader, we're thinking uranium, this nuclear play, SMRs that we've been seeing the news?
Well, energy transfer, for example, just say on let's go from natural gas to the plumbing. Energy transfer, ET equity, is down quite a bit in recent months. You're going to need massive plumbing build to support artificial intelligence. Now, we've been recommending in our bear trap support SMR equity, NuScale, in those small modular reactors for over a year now. We've been in this, and we've been in the uranium trade since 2020. So we've been in there with Cameco in trade alerts out to our clients. But I want to tell you, the SMR nuclear path to save AI is like 2 years away, right? So if you just look at the math behind NuScale, and you can see the Mag 7 companies are panicking. They're eating each other alive right now. They're investing in the NuScales of the world, the Wolves of the world. These are the types of companies that are going to provide energy infrastructure. But it's going to take at least 24 to 36 months to get that to market. In the meantime, the energy bottlenecks are going to disrupt the AI companies.
Yeah, makes sense. Okay, so that play natural gas in the short term. I mean, how should an investor play this beyond that? I mean, are you suggesting that the real trade is to be short the AI hype via, Nvidia, while simultaneously being long the AI plumbing, like you said, uranium, copper mines, things like that?
Well, that's what we're seeing very sophisticated investors do, but that's not a trade for retail. There's a lot of ways to short Nvidia. A lot of people would say you never short a stock like Nvidia. All I have to say is one of the big themes in our book, Jeremy, is the dark side of passive investing. And I'll tell you this, I've been in the business since the 80s. Jack Bogle is rolling over in his grave. The S&P 500 should never, ever, for the love of God, have two companies that are 16% of the S&P 500. That is a disgrace to passive investing. It's a disgrace to indexing. Nobody cares. The 30-year average of the top two companies in the S&P 500 has averaged around 7 to 8%. Now we've got 16%, 15, 16% of the top is inside the top two companies in the S&P 500. That's Nvidia and Microsoft. So everyone's 401k has been hijacked by artificial intelligence. Everyone's dramatically exposed to two companies that are trading at almost 30 times sales for Nvidia, 30 times sales, and 13 times sales for Microsoft. That is literally 3 standard deviations above the 30-year norm. It's bogus, and it will go down as one of the greatest mistakes in the history of passive investing.
Yeah, let's stay on the passive aggressing kind of thesis there for a second, because your report called the S&P inclusion process obviously a slime show, right? Where trillions of dollars are in index funds are forced to buy shares at these highs and then forced to sell them at the lows, as you saw with Lululemon, for instance, is what was in your report. I mean, for the tens of millions of people who have been told for years to just buy the S&P 500 ETF, what's the systemic risk that they are unknowingly taking on by participating in this, what you're calling distorted market, right?
One of the things that blew me away is I was watching Tucker Carlson. I think he had the Wolf of Wall Street on there, right? Yeah. So the Wolf of Wall Street, a man with probably the worst reputation in the last 30 years on Wall Street for hurting investors. He's found religion in indexing. He's going all in, recommending indexes, S&P 500, NASDAQ. This is what's happening with indexing is so many people are involved. Once you go from, say, active, think of active versus passive. And this comes from probably one of our most sophisticated institutional clients, veteran investor. Every 1% that passive takes from market share away from active, as we go from 51%, 52% to 59% passive versus active, every 1% destroys the index. Because what happens is there's no public floats for sale. People gain the S&P, like you said. Since Lululemon came into the S&P, it's down 60%. And what happens is the gamers, they know the companies that are going to come into the S&P. They front run them, they buy them, and then the index trackers are forced to buy these stocks. And so over time, the S&P 500 is being destroyed by the gaming, and it's all because of the market share of passive versus active.
Yeah, and those algos too. I just want to go back to this AI boom just for a quick second, and then we got to talk about this M&A. I mean, our interviews always go so fast, Larry, but while you might see this potential bust in the US, it seems like this American policy has ignited an AI boom in China. I mean, the Hang Seng Tech's up about 67%. And the only reason I ask, I mean, there's all this talk about tariffs, these different chips between China, America. I mean, is the AI theme truly breaking, or is it simply bifurcating into two competing global ecosystems?
Well, we had a scare in February around DeepSeek, right? So nobody really knows because things are moving so fast. But we had a period with the DeepSeek where people felt that, okay, China's AI investments are going to really steal market share globally. And a lot of artificial stocks in the United States from February to April were down like 40, 50, 60% in some cases. Now, Baba's been in our high conviction portfolio for 3 years. We had a capitulation buy. We were really full position. We're lightening that now, but Baba is destroying Apple. If you look at Baba, it's destroying Apple over the last 1 year, 2 year, 3 year, and almost 4 years now. So artificial intelligence with companies like Alibaba and the K-Web is destroying the S&P, the FXI. So emerging market equities in China are absolutely destroying the S&P 500 this year and over the last 2 years.
Yeah. Any worry on that China trade? I mean, right now it looks like the numbers they're putting out seems deflationary as well.
Well, we've had deflationary worries in China for a long time, but the government knows this, and they're really trying to put forth stimulus again. We've heard this for 2-3 years. We've heard and we've seen the China bond yields for the last 2 years making new lows. They're up off the lows now. But yeah, so the deflation stuff out of China has been out there, but we still have massive inflationary forces in the West.
Yeah, I got to ask you. I mean, we'll switch over to the miners. Let's talk about copper first. Back in May, you told us that the copper gold ratio is the key signal, and that when it gets near 90, investors gotta own silver, is what you said. I mean, your latest report shows that ratio has been in that territory, while also highlighting this massive divergence with Chinese copper miners on fire, while American miners are kind of lagging here. I mean, for our viewers, is this ratio telling them now is the time to sell gold and to rotate into silver and industrial metals? And given that divergence, what's the right way to play this trade?
Yes. So first, the gold-silver ratio in a real bull market should be down in the 50s or 60s. Historically, that's what happens. And what happens in the beginning of a commodity bull market, everyone hides out in the mothership. And that's gold, and that's where the first capital goes in. But as the commodity market matures, the bull market, as it matures, people start to move to tertiary plays, and that's what's been happening. So they added this week, Jeremy. They added Hecla mining to the S&P 600 small cap index. In one day, Hecla, which is a silver miner, was up 14, 15, 16%. This shows you that there's a metamorphosis going on in the market. The market is, if you just look at the copper miners, they're destroying the Qs this year. They're destroying the NASDAQ. Platinum and palladium destroying the NASDAQ this year. We've never seen a period where, say gold stocks are destroying Apple. We haven't seen something like this since the 80s. And so something very big is going on. The market's pricing in real sustained inflation and higher bond yields globally.
Let's make it actionable, right? I mean, the big news in the mining space, obviously, is this Anglo-American tech resource merger. You've been long tech since 2020, and your note says that you're now selling everything on this news. I mean, for our viewers, what does this move teach them about how to trade a hard asset cycle?
Well, copper, we love copper. We're just diversifying into copper. We love the COPX. We're long First Quantum. We're long obviously Freeport McMoran. The thing with copper globally is Panama, for example, has a mine that is one of the most productive mines on the planet Earth. Copper is close to the surface of the Earth. First Quantum owns this mine. And in recent years, it was shut down. You can get copper from this mine into the Atlantic or Pacific Ocean in literally 5 or 10 minutes. Once you get it out of the ground. And so what's happening is they're shutting down these mines globally, but for political reasons. Same thing in Chile, same thing in Peru. And so Panama, Chile, and Peru they're up to, not only, but they're up to 45% of global copper production. At the same time, we need an entire rebuild of the U.S. power grid to support artificial intelligence. Yes. So that's a lot of copper. We've got robotics. 2 million robots will take 2 years of global copper production. And people like Elon Musk are saying we need 100 million to 200 million robots. So robotics is a huge copper bull case there. Same thing with artificial intelligence. And above all, think of the Ukraine rebuild. Think of the LA rebuild. Think of the Gaza rebuild. Wars are very inflationary. The sky is the limit for copper. Copper names, I predict in the next 5 years, some of the copper names are going to be up there in the top 10 or 15% of the S&P 500. You
got to give me a couple of those names. I mean, I'm curious. I mean, because your own report shows, long gold is now the most traded trade for trade for fund managers, right? I mean, are you trimming some of those miners as a kind of tactical move against a popular trade? Has any long-term thesis changed?
Yes, today we issued a trade alert. So we went from, we were 3/3 on GDX in November. high conviction. We went down to 2/3 of maybe a month ago, and now we're down to 1/3. We're buying some of the coal names, which we can get into. The coal names, it's a big artificial intelligence play there. They're beaten up. We love trades like coal and natural gas. When what I call the hot money flush comes in, all that means is with coal, you had a big move up into the Trump election because everybody perceived that Trump's going to be great for his big, beautiful coal. And there's a number of reasons that came about to kind of reverse that, which we can get into. But at the end of the day, the coal names like Core Natural Resources, CNR, we love CNR down here. Well off the highs, more than, I think, around 50% off the highs. Great free cash flow yield. The coal names have been beaten up because a lot of that hot money that came in the fourth quarter has been flushed out, puked out into a great value down here. And it's the same thing for the natural gas names. There was supposed to be an incredibly hot summer in the Northeast, Jeremy. They were talking about record temperatures. I was in Boston and New York maybe 3 weeks ago. It was cool. We were wearing jackets on the Cape at night. The Northeast did not use as much air conditioning. Demand was way down. It was a cool summer that crushed natural gas. That's an opportunity for Antero Resources, AR Equity, and Range Resources, RRC. Companies are trading at 10 to 15% free cash flow yields, and they're buying back stock at the fastest pace in the history of the companies.
So you're buying that dip. I mean, the coal play, it's interesting because when you look at coal names, and you look at the natural gas names, it goes back to your thesis about it's going to take a while for these uranium, these SMRs. We got about 2 years of profits to make before those picks and shovels on this trade. And I guess the profit could be made on the coal and natural gas people like that, those companies?
Yes. We've seen this at least 3 times now on the front cover 2-3 years ago of The Economist magazine was the death of coal, right? And these coal stocks were in flames. It was supposed to be the Green New Deal. And they actually shut down the KOL ETF. That's how bad it got. And then from that point forward, because of global energy demand globally, the coal names exploded higher. Remember, there's 1 billion people in India that don't have air conditioning. And we've taken 5 million jobs, we've exported them around the world. We've created a whole new, really hundreds and hundreds and hundreds of millions of people, of new carbon consumers. If you're a young person in India, you're using 10 times more electricity than your great-great-grandparents. You're getting that moped, you're using oil, you're using gas, you're using electricity.
Are you looking at a lot of emerging market plays right now, thinking that there's some big opportunity, watching this new economic data coming out of China, waiting for that? India, for instance, what's happening with BRICS? You looking towards those places?
Well, India right now is dramatic. I mean, literally what they were telling us, Wall Street, 1.5 years, 2 years ago, was sell China and buy India. Yeah. And India's been almost flat on the year, and China stocks are up 30%. So whenever you see, for the love of God, a consensus on Wall Street, run. Don't walk the other way, right? So right now, I mean, just literally run as fast as you can. But this whole, I mean, this was the most consensus trade 18 months to 2 years ago. Sell China, buy India. And since then, China's destroyed India. Like I said, Baba's destroying Apple. Absolutely destroying. So I think in EM, India is a lot cheaper than China now. That's maybe you want to sell some of your China exposure and buy some India.
Interesting. Okay. I got to ask you about Bitcoin. I mean, back in May, you called it too volatile for real wealth. Since then, your own reports note that it's shown signs of maturing in recent sell-offs. I'm just curious, what's changed here? Have the institutional ETFs kind of changed your view on its role in a portfolio?
Well, there's no question that the broadening out of Bitcoin is healthy for less drawdowns. My only point with Bitcoin is I don't like the pumpers. I don't like an asset class that has strippers all over the internet promoting it. I mean, for the love of, come on. We got to get serious here. No asset class should need strippers promoting it on literally every street corner, every website. It doesn't make any sense. It tells you there's a lot of bad apples in the trade, right? There's a lot of promoters and pumpers. They need a greater fool. One thing we watch is the gold to Bitcoin ratio. And when that gets up in that, the high to mid 30s, you want to sell Bitcoin and buy gold, right?
Yeah.
And when it gets down in the 10 to say low 20s, you want to sell some gold and buy some Bitcoin. Yeah, Bitcoin's going to be around for a long time. I just don't like the pumpers and the strippers promoting an asset class.
Yeah, makes sense. And let's end on your bold call from the last interview too. I mean, you said that a hard asset company like Barrick Gold could potentially be in the top 10 of the S&P 500 by 2032. What has to happen in the world over the next decade for this to become a reality?
Well, it's already happening with long duration, every minute, every hour, every week, every month, that long-term bonds are dramatically underperforming. And that's since 2022. Like you said, there's an Apple bond that was issued at a par, which is 100, that's now trading in the mid to high 50s. So long duration, that's the first thing. The second thing you need is a situation like that's developing in Washington, where for political reasons, the Fed is being forced to kind of get aggressive, cutting interest rates when they haven't killed inflation. If you look at core CPI, core PPI, we're literally bouncing off of the 2010 to 2019 highs. We're nowhere near killing inflation. And so in that world of slower growth and sustained inflation, that gets you literally a multi-trillion-dollar rotation out of financial assets, which are just paper certificates, stock certificates, and bonds, out of financial assets into hard asset companies.
Yeah, crucial discussion, Larry. Great. Leave our audience with a final thought here. I mean, for the investor trying to find a signal in this noise that we deal with every day, I mean, it's a loud one out there. What is the single most important chart or data point that they should watch for the rest of the year?
I think overall, it's the financials versus the S&P. If there's contagion from subprime, so today it's clear there's a lot of subprime stocks that are starting to blow up. But the XLF is literally near the highs. Citigroup made a new 52-week high yesterday. So if we see a contagion from kind of this tertiary financials, which are those third-tier financials, those subprime lenders, if we see that contagion move upscale to the large cap financials, then you know, we have a real problem, not just with the economy, but with a subprime contagion that's moving uptown.
Yeah. Watch those lenders. We'll keep an eye on it here. Larry McDonald of the Bear Traps Report. Great report out this week, by the way. I went through it this morning. Just great. So I recommend the audience to go and subscribe. Thanks for your time as always, Larry. Appreciate it.
Thanks, Jeremy. Appreciate it.
Thanks so much. All right. The critical question for every investor now is, which reality are you positioned for? Let us know in the comments. Are you raising cash? Are you riding this rally? Don't forget to like the video, subscribe to our channel so you don't miss a market-moving interview for all of us here at Kitco News. I'm Jeremy Szafron. We'll see you next time.